Could Australia be heading to a 0% cash rate? Let's have a look. Hello everyone, Florian.Heise here, and welcome to another episode of HeiseSays. Grab your stein of coffee and let's have a look at this article, which is discussing, well, among other things, the prospect of Australia heading towards a 0% cash rate. Now, before we go through this, it goes through a speech by Guy Debella, one of the deputy governors from the Reserve Bank of Australia, and we'll probably go through that in another episode. I think it'd make a good live stream. But one thing you may not be aware of, if you jump over here to the ASX website, there is the RBA rate indicator. So, the RBA rate indicator shows market expectations of a change in the official cash rate set by the Reserve Bank of Australia. The indicator calculates a percentage probability of an RBA interest rate change based on the market-determined prices of the ASX 30-day interbank cash rate futures. So if we go down here, the table we can see on the trading day, yesterday, the 22nd of September, 31% believe that there's no change, or there's a 31% chance that there'll be no change. And this is a decrease to 0%, everyone, because our cash rate, I haven't updated it since October. So there's talk of it going to 0%. 69% now think it should. And from 11th of September, so 11 days ago, it's gone up from 64. But you can see it moves up and down, up and down, up and down. Because, well, it's the market. It's the market indicating what's happening. So what do you think, guys? Because one thing we have to realize that the actual benefit or the impact of monetary policy of this cash rate going from 0.25 to 0, I doubt that entire 0.25% will be passed on to consumers, and thereby you can ask the question, how much impact will it actually have, but psychologically? So, well, there's two sides to it. One, okay, fantastic, my mortgage repayments would go that tiny bit lower if the bank gives me something off my mortgage. Yeah, great, fantastic, so I get a bit more money. What would I do? Just leave it paying off at the normal rate. Or what I'll do is I will pay at that lower rate, then bank up the rest and pay it in chunks to feel better at the cost of that tiny interest difference. But, that's another thing. What they're hoping, it would encourage consumers to go out and spend, But there's another measure we need to keep aware of. Consumer sentiment and business confidence. What would happen to consumer sentiment and to business confidence if the rate was cut to 0? Would that scream confidence in the economy, V-shaped recovery going back? Or perhaps, and I'm just bringing up something else here, could it be that concerns over GDP growth, and we'll jump to the Australian GDP growth here. Trading Economics is a great website. This fall of 7%, biggest since the Great Depression, doesn't even compare to our last recession, the one that Australia had to have. Could that just decimate confidence? Is that the more dangerous signal that they will send? I mean, how confident would you feel if the bank's going to that? I guess in some regards it means it'll be one extra step for them to go back up, but then again they can jump straight up to 5% if they need to, couldn't they? That'd be a shock. So let's have a look at this article written by Gerard Coburn. The Reserve Bank of Australia says further rate cuts are on the table as ongoing lockdowns cause a grinding economic recovery. In a speech on Tuesday morning, RBA Deputy Governor Guy Debella said a future cut to the cash rate had not been ruled out, flagging the country's emergence from the financial downturn had been gradual and slow, rather than the economic snapback initially expected. Did anyone actually expect that snapback? I thought it was just the media. I thought it was the journos. I didn't think anyone that understood business would expect it, really. Did any of you expect this snapback? I thought we were all on the same page. That it was just, media spin. Dr. Debella said a move to a negative interest rate position, which has been adopted by other overseas central banks, was extraordinarily unlikely, but the RBA was considering all its policy options. The official cash rate is 0.25%, a historic low. So, I mean, extraordinarily unlikely means it's not going to happen. And regardless of whatever they say, you can just chuck it out the window. Because if they get desperate enough, they are going to chuck everything they can to keep it going. To keep it going. Honestly. What do you think? I mean, we're obsessed. We've got a housing bubble here. We've got the candle-on effect, which has just shot up our housing, because that's where pretty much all of the money is created in the economy. It's all about housing in Australia, a big chunk of it. So they'll just keep doing whatever they can. Maybe, maybe it'll be discussions next year. We'll never go to negative 5% interest rate. That's just unheard of. Negative 3 is quite reasonable. It's just bit by bit. You get adjusted to these things. You get adjusted. If they get desperate enough, they'll do it. They've done it overseas. Other central banks have. And we're still looking better compared to other countries, but it just depends on, there's a different methodology of measuring things. You compare our unemployment rate, which has gone down to 6.8%. Nope, that's building approvals. 6.8%. If we were measuring it the same as the US, we'd be doing much worse. Given the outlook for inflation and employment is not consistent with the bank's objectives over the period ahead, the board continues to assess other policy options, he said. Well, they don't really have that much. They can push the government for fiscal stimulus, or they can keep reducing the cash rate. They can intervene other ways, but the country's roadmap out of the lockdown has been hampered by the ongoing shutdown in Victoria, which is fueled by a two-pronged recovery from the economy. Dr. DeBella said the recovery was also to be held back by a large shortfall in demand that usually occurred during a recession. Overall, the recovery has not been a rapid bounce, but a slow grind, he said. Can there even be a talk of a recovery yet? Well, we've got all these mechanisms in the economy, all these supports under the slab that's holding up the economy. Can we even say that we've recovered? That we've got structural integrity in our economy until those supports are removed? Because there's always the risk there'll always be the constant risk of when these supports are moved, it'll collapse. And you can see in the articles, there's fear in, this end of this month, once JobKeeper is cut and JobSeeker is cut, that there'll be a hit. And there will be some people that are going to struggle with reduced money. Overall, the recovery, we've seen that. Until households and businesses are confident about future demand and income, they'll be reluctant to spend and invest. Dr. DeBell said the strongest recovery had been in Western Australia, which is experiencing retail consumption at pre-COVID-19 levels. The RBA expects the economic demise of Victoria has subtracted 2% from national GDP in the September quarter. The Deputy Governor's choppy outlook also coincides with weekly payroll figures that show the week ending September 5, payroll jobs decreased 4.5%. ANZ economist David Plank said the RBA's monetary policy mechanisms were likely to be on hold for the remainder of 2020, but further steps seemed likely. Dr. DeBell noted the adoption of a negative interest rate position could impact consumption levels and hinder the financial system in the medium to long term. I remember we watched the Reserve Bank Governor, Philip Lowe, at a Senate committee, and one thing he raised about negative interest rates was that it actually has a reverse effect. It encourages just people to save more. Okay, that's what they found. You're thinking, I'm going to lose, there's a cost to saving this money, so I better throw more on there to absorb that cost. That's what they saw happening. I mean, you've got to think about it. There's a cost to holding your money. And, I mean, if we go to negative interest rates and there's a cost to holding your money, do you think that'll push into property? I mean, that's the Australian response to everything. It's property. It has to be property. Negative interest rates can also encourage more savings. Okay, there we go. As households look to preserve the value of their savings, particularly in an environment where they are already inclined to save rather than spend, he said. Oh, exactly. And our saving rates is the highest it's ever been. Over 19%? Something crazy. People are scared, everyone. People are worried. The RBA has indicated it may expand its bond buying regime to incorporate bonds with longer yield maturities than 3 years. Targeting bonds with longer maturities could assist in lowering the exchange rate of the Australian dollar if the currency is deemed to not be in line with its fundamental trading price expectations. The central bank previously noted the currency was trading within expectations and reflecting a weaker US dollar against other major currencies, and also high demand from iron ore, primarily from China. The RBA's balance sheet during the downturn has almost doubled to $300 billion, reflecting its bond buying program and term funding facility, which is providing the financial system with cheap liquidity. So there we have it, everyone. Discussions of cutting the cash rate, potentially going to negative. It's not, it's unexpected. But who would have thought? Who would have thought, guys, that this cash rate, would have a rate this low? 0.25%. Would have seemed unimaginable years ago. As always, thank you all for watching. Please like, share, and subscribe to the channel. If you're a fan and want to support the content I created, there are a few ways you can. You can join the channel on YouTube or Patreon. You can support us using our affiliate links at Amazon, eBay, Independent Reserve, or Kucoin. You can buy merch from HeiseSays, use Gold Pass from the Perth Mint, or support us via PayPal. Take care, guys. Have a great day. I'll see you next time.